Hello and welcome to this special edition of Expert Talk. I am Muralidhar Swaminathan. The big issue that is facing the markets today is how long will the bull run last? The bulls are unstoppable, the fund flow is relentless, and there doesn't seem to be a cap on where stocks will reach. Are we at risk if we invest today? Or if we don't, will we miss the bus? This is a very tough question for us to navigate and find answers to, but it's very important to bring expert opinion. Today's expert is Akshay Bhargava. Akshay Bhargava has several decades of experience both in startup ventures as well as financial markets. He has also headed banks and is very, very well versed with wealth management across different geographies. Akshay, welcome to the show and wish you all the best for your new venture. I'm sure your new venture will help investors create wealth.
Thank you, Murli. Great pleasure to be here and a privilege to be invited to speak on your show.
Well, actually, the trillion dollar question, I'm calling it a trillion dollar question because the markets have run up a lot over the last 1.5 years, and whether it's the US or India or any other market for that matter. So calling it a billion dollar question will be out of fashion. So the trillion dollar question is, how long will this bull run last? Are we going to face risks if we continue to invest? Or if we don't, will we miss the bus? Your thoughts?
Yeah. So, Murli, you have asked absolutely the perfect question to start something like this. And the whole and it also underscores the reason behind what we do, our product Investor AI, which I will talk about later. But let's just get to your question. I think there is something wonderful happening in the world, and it has accelerated during lockdown. Okay, I think there is a whole generation of new investors that is entering the markets. India has added 18 million customers. US, by my latest count, has added something like 10 million new customers. UK has grown by 4 or 5 million new customers. So it is happening around the world. There was a very interesting fact announcement yesterday from UK's largest broker, Hargreaves Lansdown. They have 1.6 million customers now. Wow. In the last 1 year, okay, they had so many customers coming in. The average age of their users has gone from 55 to 46 in 1 year on a base of 1.6 million. So, this is an incredible demographic shift. And it speaks to what is happening in the world, including India is a leader in all this. Yeah. Because there's so many young people, they're all coming into the markets in Investor AI. I talk to them every week in my webinar. You've been to one of our webinars, so you know what it's like. But if I really look at global economy, the world is coming out of the COVID lockdown period. COVID lockdown increased consumption in some industries and decreased consumption in many industries. Okay, people had a lot of income because they were not going out and not doing anything, and some of them, that money has flowed into the stock markets. But even before COVID started, there was a lot of liquidity in the world, and you just have to. Everybody was talking about excess liquidity. One example of this excess liquidity is the SPAC boom. If you've come across the SPAC, SPAC, Special Purpose Acquisition Companies, something like $2 billion went into SPAC in the first 4 months of this year. Unprecedented amount of money. So there's a lot of cash in the world. That's the point I'm making. Whether it is with pension funds, whether it is with endowments of universities, whether it is with family offices, whether it is with wealth managers, and this cash is very sticky. It doesn't move. I was talking to a friend of mine who runs a large company in the US, and he was saying people are buying gold, and they're buying gold because they're afraid government will change rules and take their wealth away. So, there is a mindset in the world that says cash is king. And there's a lot of cash in the world. As long as there is cash in the world, I think equity market and cash relationship is very obvious. That is one. Secondly, you are now seeing extraordinary growth companies. I look at Zomato. Okay, look at Dark Trace, which has doubled in price in 3 months of IPO. Look at Snowflake, which went public and in 2 days it doubled. Look at Airbnb. So there is massive growth taking place, not in 500 million, 1 billion market cap companies, but 13, 14, 20 billion market cap companies. You know, Coinbase, IPO'd at 83 billion. These are giant size companies. So that's the other thing. There are growth stocks that are, driving a lot of growth in the markets. Finally, I think there is a fluidity between alternative markets and equity markets that has never existed before. So today, if you talk to a young person, in UK, I will tell you a statistic. Of the new investors, it's only 17% in the last 1 year invested in mutual funds. 51% invested in equities. And 22% invested in crypto. So in a young person's mind, what are the choices? Mutual funds, crypto, and stock markets or cash. Okay. So, so if I'm a young person, I'm very willing to put it either in crypto or in the markets, whichever sort of, and I will switch between the two. So, so there are market boundaries have become porous. Okay. And that is also increasing the velocity of what is happening. And the final reason that is increasing the velocity of money, of trading, is just the sheer number of online brokers. I mean, just look at India. Zerodha is the leader, but there is Grow, there is 5paisa, there is something else. 100 brokers are willing to do, you can trade for free. Maybe not 100, but a whole bunch of them. They have made it so easy to trade. Okay, and of course, the problem is you don't know what to buy. That is where investor AI comes in. But if I stay with the markets, I think there is a lot of liquidity. I think there is a lot of new demand coming from investors. So, and finally, the interest rates are nothing. UK interest rates are 10 basis points. US interest rates are extremely low, all-time low. People are talking about potential negative interest rates in the Western world.
Absolutely. Yeah.
So you can't make money by keeping cash. You can, and you pay a lot of fees if you go to mutual funds. So equity markets, I think, so from all these points of view, I don't see this rally changing. I think we are going to see a 5-year bull run in global equity markets.
Right.
Now, how India will react is a different matter because India is a slightly smaller market, and there are, despite so many stocks that are listed, there are probably 200 stocks that consume 90% of the flows. So India has slightly different dynamics, but globally, I don't see it changing.
Yeah, that's right. But we are navigating the markets, and the markets are setting new records every day, every week, every month. Month after month, we are seeing new records in spite of the pandemic, in spite of uncertainty about growth, in spite of fall in demand, and the fear that of uncertainty, what we don't know. Now, what are the risks here? Anybody who gets in today makes money with any stock, but the person who does not get in misses the bus. How does one navigate this market?
So the answer to your question is yes and yes. Okay, so yes, there are risks. There are always risks. If you're an investor, if you haven't lost money, you're a child. Okay, you're not invested for long enough. You will always lose money at some point in your investment journey. If you're not accustomed to that, do not invest. Stay in cash or FD or something like that. Okay, so it's like if you're a sportsman, you will enjoy yourself. How can you not enjoy yourself ever? If you haven't enjoyed yourself, you have not played your sport for long enough. So losing money is a fact of life. The point is that what do you do? How do you act to losses? Do you panic and run? Then you recognize your losses immediately and you will never recover. Or do you make a thoughtful investment and then knowing it will lose money at some time and stay with it for the long run? Now, if you look at, I was doing this bit of research for an article I was writing, and I looked at, this is data from LiveMint. In the last 40 years, Indian stock markets have delivered average compound growth rate of 17% per year. So 40 साल में 17% को हर साल मिल रहा है. Now, of course, it goes up and down. But if you had invested 40 years ago and you invested now, 1 lakh would be 5.1 crores. If you had not taken it, just at 17%. Nothing better than market, nothing worse than market. So it depends on your perspective, Murli. If you have a long-term perspective, I think in India you will make money because it is a growing economy. And there is always a shortage of good stocks. So that long-term, yes, you lose money, but you will also make money. The thing you should not do is cut and run. Then it is over. You will never make any more money. Then the question is, should you be stock picking? And should you be? Of course, you should be stock picking. Of course, you should be applying your market knowledge, intelligence, using tools like Investor AI to find good stocks. Because in a rising market or in a declining market, there are always opportunities. And if there is something that helps you identify, you will then do better than market. So that's why I said your answer to your question is yes, you will lose money. And yes, you should be stock picking also.
Yeah. The important question is today or till yesterday, most investors could make money. They could close their eyes, put their finger on any stock, and they would have made money. But the question is, if I invest today, I have to be very, very careful. I will have to pick the right stock. Now, for example, there are many fintech companies. Why even your own product should be able to identify? Does your product help investors pick the right stock? And uh, maybe you should give us some examples from AI investor so that investors can understand how this works and how they need to select the stocks.
So I'll give you one example that will make it clear. Firstly, Investor AI is not advisory. It does not tell you what to do. It just shows you what is happening, and you decide what to do. So it is meant to empower the investor rather than advise the investor. So we have one particular algo that is most popular. It's called Alpha 330. So what it does, it looks for stocks that have a high probability to deliver at least a 3% return in 30 days. Okay. Now, it's all very interesting, but all our algos are predictive in nature. So unlike other platforms that tell you what has happened, we tell you what is likely to happen. So this algo identifies stocks that are potential breakouts. Okay, it is not always right. We publish accuracy, on the app, and sometimes the accuracy is 65%, sometimes it's 75%. It changes every day, but it is by and large quite an accurate algo. And when the breakout happened, so it picked up Tejas Networks before the breakout happened. Mm-hmm. And you know what happened to Tejas? It just boomed, and then it kept breaking circuit every day for the whole week. Okay, so it did that. It picked up a company called Hikal. I don't know if I'm pronouncing it correctly. I don't even know what it is. And it went up like 150%. It picked up Oracle Financial Services. And these are just some recent examples, which went up, I think, 25, 30%. I can't remember exact number. So it finds good stocks. Now, it will find you an opportunity that it thinks is a breakout. It may not always be correct. You have to supplement it with your own research. See, if Oracle Financial Services comes up as a signal, you must have a view on Oracle Financial Services. If you don't buy it. Okay. So it is a combination of you plus the machine that makes the magic happen. That is our philosophical view with Investor AI.
Okay, great. Now, the point here is, your product will help me identify the stock, and your product will also send out alerts. But will your product tell me how much to buy? What should be the kind of exposure? Should it be 1%, 2%, 5%, or even 10%? Can your product help investors find the right exposure?
No, we don't do a portfolio allocation. Okay, that you have to do. So I'm going to be so much in cash, so much in equities, so much in bonds, so much unit trust, whatever it is. And then once you decide this is my equity portion, within that portion, we give you ideas. Okay, so we're not doing a risk assessment of Murli, the investor. We're not risk assessing your circumstances. We're not telling you you must invest so much in insurance, so much in this, so much in that. That your advisor or somebody will do. We are not your advisor. We are your investment assistant. We are telling you, sir, आज market में ये हो रहा है. Please pay attention in case you are interested. That is how we work.
Yeah, okay. So let me now turn to the Indian markets. We are witnessing a very, very interesting trend, especially over the last 1.5 years. And of course, you've also given us a lot of data and statistics, spanning over the last 1 year to 1.5 years. The point is, we are finding new investors who are coming in every day I find new investors who are coming. Anecdotally, I have seen this among the relatives in the family, among friends, among college students, and there are many students who have just joined work and they have started investing. The point is, most of these investors have an average of age of 30 to 32, maybe even less, 25, 26, 28, because they know that this is the market where they can make money and they have surplus. Now, where does the surplus come from? It's money not spent on shopping, on fuel, traveling to office, meeting friends, or splurging, or even eating out. That's a lot of money with youngsters. So that money is coming in, and we are seeing lot of domestic flows coming in. There may not be exact estimates, but we know the number of investors who have come in. Do you think this trend will continue, or will this trend change once the pandemic ends and people rush back to shopping?
You raise a very interesting point, something that is very close to my heart. I have not done anything about it, but I will tell you anyway. I think India is fundamentally an aspirational society. We all want to do better than our parents. Our parents want us to do better than themselves. You surely have far greater ambitions for your children than you had when you were, at their age. So aspiration is in our DNA. Secondly, I think resourcefulness, entrepreneurship, what we in Hindi call jugaad, is in our DNA. Everybody has that to some degree. Some people are more than others. So I think this playing in the market, it sort of, it plays to those strengths. But if you take a step, so I don't think that is going to change. That was what I was trying to say. But if I take a very big step back and if I look at how many investors are actually investing in the market, and I remove the deduplication, you as a fund investor, you as an equity investor, you and your wife in your demat account, your single demat account, her single. If I remove all that, I reckon there are about 4% of the country that actually invests. And my real long-term ambition is, how do I get this to 20%? And that is not just about giving investment ideas. That is about comfort, education, training, coaching, hand-holding, making it very easy to enter, making it very easy to exit, allowing people to experiment. And I think technology allows that. And what we are building is the first building block in that foundation, where one day I hope we will be able to get into. Because if we can take that 4% to 20%, we will change the country. And I think in India, that is the opportunity.
Yeah, one more very important trend, Akshaya, which is happening now, which may have happened in other markets a couple of years back, is the rush of new IPOs. We are witnessing a large number of companies who are coming in, participating in this bull run. That's very common in a bull run. But what is different this time around is that there are a number of startups, in any field for that matter. So today we have Zomato, Devyani International, Burger King some time back. All these companies are not earning profits, but they are very big in their domain. They are so big that there are entry barriers as well. Now, they attract millions of hits. The issue is oversubscribed several times, and when it gets listed, they list at sometimes 100% premium, sometimes 50% premium. This trend has caught up in this market, and we are seeing that the stocks after the initial burst, you know, they fall flat, in the sense they don't move much. They are in 30 to 40% premium over the market. The question is, should one buy after the first burst of premium settles, or should we wait, and how long should one wait? Your thoughts?
So look, the way I see it, I see some. Mentally, I classify stocks as you know long-term stocks or trading stocks. That's sort of how I think about the world. I don't really bother with things like capital structure, volatility, etc., because the markets are volatile. So I will, and if you let's just stay with the IPO numbers. There was a company called Palantir that went IPO or did a direct listing about 8 months ago. It IPO'd at $9. Actually, I IPO'd at $6, shot up to $9 immediately, and I invested some money because I really liked the company. It is an AI company. It does all kinds of cool analytics and stuff. So I read up a lot about the company. So I bought the company. So I said, I want to buy it. So I bought the stock, and I just held on to it. I still haven't sold it. It's now $21. Okay, so because if you like the company and you understand what it is doing, you like the management, then chances are it is going to do well. Airbnb. I really like the company. I am a big fan of Brian Chesky. I think he's really one of the visionary entrepreneurs. And a story that for the first 4 years, nobody would put money in Airbnb. Really kind of hard, I find it heartwarming. I think the business is fantastic. I think they're really focused on the customer. So when they IPO'd it, I can't remember what, $83 and they went up to 140 or something. No, sorry, they doubled within 2 hours of IPO or something like that. I sort of sighed a little. Then I waited for it to come down. Then I bought it 140 or something like that, and it hasn't. The stock is still low. It hasn't picked up. So I'm in the red on Airbnb. But I like the company. I know it is going to do well in the future. I think once consumption comes back, it will do well. So that is my conviction. So I'm just holding on to it. I'm not really bothered that I'm not making money. So those are two examples for me. The common thread here, Murli, for me, is that you must understand the company. You must have a view. So Robinhood, for me, is a trading stock. It's not a long-term hold. I think that payment for order flow model is wrong. It is morally wrong. It creates all kinds of conflicts. It does not ensure best execution. I think it is going to collapse. And with that, Robinhood will have an existential crisis that because if revenue chala gaya, how will you do anything? So 50% of revenue is order flow. So I think that company is going to have problems, but not today. They will have problems 2-3 years down the road. So I bought Robinhood and I made a little bit of money on it because it went from 40 to 83, then came back to 60, and it was been going this and that. So I see that as a trading stock. But I would never touch any of them if I did not understand it. Right. So there is an IPO coming on Nika, which I think is going to happen sometime. And it is run by Falguni, who's an old personal friend. And she's a fantastic individual, and she's a very, very good manager. And the moment that IPO happens, I don't care about the price. I'm going to buy it because I know the management. I trust the management. I think it's a great model. They have been at it for, I don't know what, 10 years now. And they've built a very successful business. So from time to time, will they miss earnings target? Yes, I know. But if that's a stock I like in the long run. So that's what I mean. If I like the company, I trust it in the long run, then short-term blips don't matter to me.
Okay, let me be a little more specific. The problem with these companies is that the pricing or the valuation is done on the basis of sales because they don't have earnings. And the other point that many analysts raise is that the entry barrier. Now, for example, in the food delivery business, we have Zomato and Swiggy. They're just two giants there, and it gives the impression that there may not be entry barrier. Of course, tomorrow if someone like Mukesh Ambani wants to enter, I don't think that would be an entry barrier, or any other large group with huge amount of capital, they can afford to enter. But the question is, should one also look at the entry barriers or the first mover advantage, so that my investment does not go wrong even at this stage, even after a premium of 30 to 40%? Your thoughts?
That is a seriously good question. My head says earnings, but my heart sort of, I look at things and say, earnings are kya ho gaya? No one seems to care.
No one seems to care. Yeah.
No one seems to care. Okay, so let me just, as an aside, for Mukesh Ambani, I don't think there is any entry barrier in any industry.
Yeah.
If he decides ye karna hai, to karna hai, ho jayega phir. But if you look at, take UK, okay? Deliveroo, which is like Swiggy and Zomato, just public, and its biggest competitor, Just Eats, had gone public about 1.5 years earlier. Now, being the first matters. Just Eats is losing money, Deliveroo also losing money. Okay, but the moment Deliveroo went public, they were second. All analysts compared it to Just Eats because Just Eat numbers were available. And if in comparison you look better, then you get preferred. If you don't look better, so all of a sudden the benchmark which in the industry became an important thing. So I think Zomato has done the same thing for Swiggy. Zomato is the benchmark. When Swiggy goes public, they will be measured by Zomato benchmarks. Whether they come, and if I was on their board, I would say make sure that your metrics look better than Zomato's.
Right.
Otherwise, you won't have such a good IPO.
You just have a couple of products. Are you planning to launch more products, because investors may want different combinations of portfolios, etc.?
So Investor AI, we launched about 6 months ago, and we formally announced it recently. We have just launched a product this week on Monday, which we call FTM portfolios. FTM stands for Follow the Machine. These are, we have taken the best signals from Investor AI. We have packaged them into 10 stock portfolios. One is a value portfolio and one is a momentum portfolio. And we have made it available. We have published it on the small case website for anyone to subscribe. The value portfolio is 1,000 rupees a month. The momentum portfolio is 2,000 rupees a month. And one click buy, one click sell, one click rebalance, very easy. So for me, that is a very, very important thing because see, Investor AI is for people like you who understand the markets, or people like young people who want to understand the market, and you have the time. So good market understanding, and you have the time. Investor AI. If you're the kind of investor who wants exposure to the markets but can't be bothered to decide kab kharidna hai, kab bechna hai, so not when to buy, when to sell, for them portfolios is perfect. FTM portfolios. Just one click buy, and then you basically do nothing. You don't have to watch it at all. Once a week or once a month, we will send you an email saying no, portfolio has rebalanced. Just press one click and it's done. So the FTM portfolios is for people who don't want to keep track every minute of the day, when to buy, when to sell. Then there's a third product we were coming up with, which I won't give you too much detail on, is meant for the Murli, the investor who does not have any time, where you can just automatically train the AI to do whatever it is you want, buy this, buy that, sell it at this point, and all that. So it's quite a complicated little structure, but we want to. The reason we are taking time is because we want to present it in a very simple way. So as you know, making things simple is very, very hard. So we've got the basic engineering, but usko simplify kaise karna hai, wo chal raha hai abhi. Right. So that's what we are doing. We'll keep coming up with products. So that is again in our DNA to constantly innovate and things. And India is a very important market for us. So whatever we come up with, India will see it either first or before everybody else also.
Okay, yeah, in the small case, for example, one small case, you can create many small case portfolios, if I can call it that. People may want more than one small case because, if you have a handful of, let's say, 7 or 8 or 10 stocks in one small case, as against another set of 10, because today we have hundreds of stocks in the market. So if one combination works today, yet another combination may not work today, but it could work some other day. So are you planning to offer many such combinations of portfolios?
So right now, Murli, we have only two portfolios. Uh, it is part of our roadmap to add more portfolios to it. We will do this over time, but as of now, there are only two. The portfolios. So look, the way we work is the machine is saying these are the 10 stocks for this week. Okay, now you can buy in the proportion that the machine is suggesting. You can buy more of one, less of something else. You could say, I don't like this stock, just take it out completely. And you have a lot of flexibility to tweak the portfolio as the machine is saying. But the machine is saying what it is saying. Now, if you tweak the portfolio, your portfolio performance will become slightly different from the machine portfolio performance. So we call that tracking error. So you'll have some tracking error. And over time, the tracking error will become bigger and bigger. Tracking error may be in your favor, may not be in your favor. I don't know. Okay, that depends on what decisions you take. But you have full flexibility.
Okay, my next question is going to be something very important for many investors, especially long term investors. You know, buying is very easy. You can enter at any point in time in the market and hold for reasonably medium to long term, and you will make money. But selling is very difficult. At which point do you sell? Do you sell after the stock doubles? Do you sell when the stock gives you 20%? Or do you just keep on holding and watching the stock keep going up? But the problem is, once you sell, after you sell, prices fall. Investors will regret. So, my question to you is, your system throws up alerts for buying opportunities. You could say that, look, this particular stock is going to break out, so here is a great opportunity, go ahead and buy. But will your system give alerts for selling? Say that, look, this stock is going to stagnate, it might be range bound over a period of time, and if you want to sell, you should sell. So can you give us your thoughts, and does your system have this provision?
The system cannot tell you when to sell because it does not know what price you bought it at. Okay, so that is one practical difficulty. But more importantly, when to sell is very closely intertwined with why you bought. Okay, if you bought for a short-term return, if you got the return, leave, sell and go. If you bought like Palantir for me or Airbnb for the longer term, then stay with it. So your objective in why you bought the stock matters a lot. What is in the subtext of your message? See, when how much money is enough money is a very personal question. For you, 3% may be enough. For me, 5% may not be enough. So that determines when to sell. But what you're really saying, is there a signal in the AI that tells you that stock is going to fall? That we don't have that as yet, because then there's a reason for that, because we can generate the signal. It's the same mathematics, the
Yeah.
same model. But we don't do it because then the only way you can take advantage of that is by shorting the stock. And as you know, shorting is not permitted in India. Now, you can go to the F&O market, but the F&O market is what, 170 stocks, 150 stocks. So it is not a universally applicable answer. That's why we have not done it in India.
Actually, one last question. Now, this is a very important question for retail investors. Most retail investors have surplus of 10,000 to 20,000 per month, depending on their age, experience, and income level. There are different channels of investing that are available and open to investors. They can go ahead and invest directly in the market. If they have a reasonable lump sum, they can also go for a portfolio management scheme, or they can go for mutual funds. What is your advice to investors, especially retail investors, long-term investors, not short-term and medium-term investors? What is your advice? Which route should they take?
So my first advice to the retail investor would be, number one, start early. Okay, the power of compounding is the biggest investment tool in your favor. And people don't understand that. So whatever you invest, mutual fund, bond, whatever, I don't care, but you must start as early as you can. Okay, because I did not start investing till I was about 36, 37, because I just didn't have enough disposable income. Okay, and investing was not so easy also, especially if you work for a bank, then there are all kinds of constraints and things. So you have, the earlier you start, the better it is. So that is the first piece of advice I would give. The second piece of advice I would give is allocate your portfolio a little bit. So don't go everything into one kind of category. Give some, depending on how much money you have. If you don't have any knowledge of the markets, then don't do direct investing. Then go to a mutual fund, and then look for mutual funds that have the lowest cost ratio, because even 0.5% can make a big difference. If you have some experience or some inclination to learn, to take a little bit of a portfolio and start dabbling in the markets. As you get confidence, you can then increase that portfolio. PMS, I frankly don't see why anyone should go into PMS at all. Because what does PMS do? They manage a bespoke portfolio for you. You can find those portfolios on there are 100 portfolios on small case side. All of them, they don't charge 1 or 2% like PMS. They charge much less. So if you have 20, 25 lakhs, then you can just go invest there at a much lower cost. Automatically, your return goes up by 1.5% just through fees. Okay, so I think there are many more choices in the world. And just close on this point, my view is that the digital generation of investors that we are beginning to see now, people who like to do everything on their mobiles, is going to drive the wealth management of tomorrow. Because they don't like to pay high fees. They don't trust banks, at least in the West, they don't. They don't trust institutions. They don't even trust advisors. They trust their friends. They trust influencers like yourself, who they see as objective and dispassionate. And they are going to want a way to do things for themselves rather than have somebody else manage their money. And this DIY investing generation, do it yourself, is going to transform wealth management in the next 20 years. That is my view. And that is why I'm getting Bridgeweave to build the kind of products that I believe will be the products of tomorrow.
Yeah, you are absolutely right. You've kind of hit the nail on the head. The younger population, the younger investor today, they are tech savvy. They have surplus money, and of course, you know, they want to do anything and everything that they want to decide whether to buy, sell, or whether it's. In fact, they want to treat investing in stocks as just as they would shop on Amazon. I think the perspective that you have provided will help a number of investors. And thank you so much for sharing your thoughts and wish you all the best with your new venture.